In order to understand what makes up a balance sheet, we need to define a number of terms. Let's begin with the asset side of the balance sheet. Assets are things that a company owns. This includes cash in the bank, furniture in the office, and equipment and technology that's used to create goods or services. Assets are organized into two groups. The first is current assets. Current assets are assets that are expected to be used within 1 year's time. They include things like cash, inventory, and accounts receivable. The second category is non-current assets. Non-current assets are expected to last more than a year's time and include things like property, plant, and equipment, technology, patents, trademarks, etc. Non-current assets are typically grouped into two categories: tangible and intangible assets. Tangible being those that are physical, like property, plant, and equipment, and intangible being those like patents and trademarks that are not physical. By totaling the current assets and the non-current assets, we arrive at the total assets of the business. This forms the left side of the balance sheet, which must equal the right side of the balance sheet. Moving on to the right side of the balance sheet, we have two categories: liabilities and shareholders' equity. Liabilities are what the company owes. And just as with the asset side of the balance sheet, those liabilities are broken down into current liabilities, those that are due within 1 year's time, and non-current liabilities, those that are due in more than a year's time. Current liabilities typically include accounts payable, which is the amount owed to suppliers. Whenever a company purchases something on credit, it results in accounts payable. Most suppliers provide anywhere from 30 to 90 days as their terms for payment. So a company will have an accounts payable balance that is expected to be paid off, typically within 30 to 90 days. On the non-current liability side, things like long-term debt, which would be any loan that's due in more than a year's time, are recorded here under non-current liabilities. By adding together all of the company's current liabilities and all of its non-current liabilities, we arrive at the total liabilities line on the balance sheet. The shareholders' equity section is what the business is worth after all liabilities have been paid off. At the beginning of a business, the shareholders' equity is equal to the amount that's initially invested in the company. This is referred to as shared capital. The investors get common shares in exchange for providing money or capital to the business. Then, over time, the balance can go up or down as the company either earns profit or records losses. If the company produces a profit, that net income flows into shareholders' equity as retained earnings. Those earnings can be retained and remain on the balance sheet, or they can be paid out in the form of dividends, which reduces retained earnings. If losses are generated, those also reduce the retained earnings account. So retained earnings is essentially a running total that shows how much profit the company has generated, less any losses, and less any dividends that have been paid out. At the end of the day, the total shareholders' equity value must be equal to the total assets minus the total liabilities.